Stop buying real estate with your emotions. Retail investors look for a nice view. Institutional investors look for the discrepancy. After 20 years in banking, I can tell you a secret. While you are fighting with broker fees, leaking roofs and tenant headaches, the pros are buying the exact same assets at a 15 to 80% discount. Today, I'll show you why an Amazon warehouse in rural India is safer than a luxury apartment in New York. I will teach you how to peel the cost onion of the property market and how to sit at the same table as billionaires without ever signing a lease. We're going to deconstruct concrete gold. By the end of this video, you will never look at real estate listings again without asking two questions. What is the AFFO and where is the maturity wall? Quick disclaimer, this is financial education, not investment advice. But first, what is a REIT? REIT stands for Real Estate Investment Trust. It is a company that owns real estate, office towers, warehouses, hospitals, data centers, and it is legally required to pay out at least 90% of its profits to shareholders as dividends. Think of it as a fund that lets you own a piece of a skyscraper, a hospital, or a warehouse starting with as little as $50. You buy it on a stock exchange, just like a share of Apple or Tesla. No mortgage, no notary, no tenant call at 2 a.m. in the night. Now, the old wisdom of location is dangerous simplification. For us, the focus is on capital structure, a tenant credit quality. Let me show you what I mean. Imagine two properties. Property A logistics center in rural India. The tenant, Amazon, AA rating. The lease, a 10-year triple net contract. Now, triple net means the tenant, not you, pays for three things: property taxes, insurance, and maintenance. You just collect the rent check. That is why professional investors love these contracts. Property B, a luxury tower in Manhattan, world-class location. But you have 100 individual tenants, high turnover, and rent control laws that change every election cycle. To a pro, Property A wins. Why? Because it isn't a building, it's a corporate bond from Amazon, wrapped in concrete. We don't buy zip codes, we buy guaranteed rental income, locked in by contract. Now, let's talk about the price. When someone appraises a house, they look at what similar homes sold for a month ago. That means the price tag is always outdated. It's like driving a car while only looking in the rearview mirror. REITs don't have that problem. They are traded on the stock market, which means the price updates every single second. They have already priced in the interest rate shock. The results in 2026, while physical sellers are still clinching to fantasy prices from 2021, REITs are trading at a median discount to their net asset value. In simple terms, on the stock market, you can buy real estate for 85 cents on the dollar. If you buy physical today, you're buying yesterday's price. If you buy REITs, you're using a price that updates every second, based on real supply and demand. Now, let's peel the cost onion. When you buy a house physically, you have already lost the game before you got the key. Broker commissions, gone. Notary fee, gone. Transfer taxes, it's gone. You're essentially starting your investment with a 9% loss. It takes years of rent to just break even. By contrast, buying a REIT costs you less than 1% in fees. Now, if you think that cost advantage is already unfair, wait until you see what comes next. Because in the next section I will show you the one metric the Wall Street uses to separate real cash flow from accounting fiction. And I will reveal the $1.8 trillion time bomb that most investors are sleepwalking into right now. This is where it gets serious. Stay with me. Let's talk about the escape hatch in finance. We call it the liquidity premium. Selling a physical property takes 8 to 12 months. In banking, we can sell a REIT position in seconds. In a crisis, the ability to leave the room immediately is the most valuable insurance you can own. Now, here is the mistake I see all the time. People try to value a REIT using the standard PE ratio, the price divided by earnings. This is a beginner's trap. Here's why. Accounting rules say that buildings lose value over time. That is called depreciation. But think about it. A well-maintained apartment building does not actually lose value. It often gains value. So depreciation is fake cost that only exists on paper, not in real life. And it makes the earnings number look artificially low. This is why pros ignore the E, earnings. Instead, we look at FFO, funds from operations. Funds from operations takes the earnings and adds back the fake depreciation number. But the true gold standard is the AFFO, adjusted funds from operations. Think of AFFO as the cash that actually lands in your pocket after you keep the building standing. FFO gives you the big picture. AFFO subtracts the real cost, like fixing the elevator, replacing the roof, or installing new carpets. AFFO is the honest number. It tells you how much cash is really left for me as a shareholder. Now, the red flag rule. If a REIT's dividend is higher than its AFFO, run. This is not income. They are slowly giving back your own money. That's not a yield, that is liquidation in disguise. Now, the ticking time bomb I promised you. In 2026, the risk isn't how much you owe, but when you owe it. We're hitting a commercial real estate maturity wall. $1.8 trillion in loans need refinancing. What does that mean in plain English? Well, companies borrowed money years ago when interest rates were low, at around 3%. Now those loans are expiring, and they have to take out new loans at 6 to 7%. Their interest costs are about to double. As a banker, I audit something called the WAM, Weighted Average Maturity. It tells us how many years the cheap money is still locked in. Think of it like a countdown clock on a loan. The higher the number, the more time the company has before it needs to refinance. Good REIT, WAM of 6 to 8 years, they can wait out a storm. Bad REIT, WAM under 3 years. This is the danger zone. Their interest rate costs will double before they can raise rents or compensate. Real estate builds wealth, but only if you drop the brick and mortar emotion. So, here's the 2026 checklist. Focus on sector selection. Avoid offices. Remote work is not going away. Target data centers. The AI boom needs physical infrastructure. And healthcare. Aging populations guarantee demand. Run the forensics. Never buy without checking the AFFO coverage and the WAM. Take the discount. Why pay full price physically when the market offers you a 50% discount for the same concrete? Let me give you a quick real-world example that checks all the boxes. For example, Prologis, ticker PLD, is the world's largest logistics REIT. They own warehouses leased to Amazon, FedEx, DHL. The WAM is solid, well above the danger zone. The AFFO comfortably covers the dividend. And in early 2026, they trade at a discount to the net asset value. That is the kind of box checking I'm talking about. Stop buying real estate with your gut and start buying with your calculator. A property in your portfolio is safer than a key in your hand. Next time, we go where the system is most fragile, derivatives. I'll show you how banks construct insurance that almost no one understands. I'm Philip, stay skeptical, see you in the next video.